Okay, give a few minutes for people coming in. But the trade-off is what? The money you pay the premium is after tax. Meaning what? You cannot save tax on left side and you get the money out on the right side. You're double dipping. The IRS does not allow that. So IRS said, with the money coming to the policy, premium is after tax, no deductions. And when you get the money out from that benefits, is also no taxes. So life is fair. Okay? That's why when you take a loan out of policies, same thing. Its loan is not an income. That's why you don't need to pay tax either. That's why life insurance, I know money out of your cash, it could be painful, but the compounding with $1 million death benefits is very rewarding because it's guaranteed, because whole life is guaranteed. I mean, they all understand life insurance is guaranteed because no matter how long you live, one day you die. You die, you get death benefits to family. Right. So that's why my point. I want to talk with the tax thing. All right. On the left side, Ted, can you read the left 10 different strategies I want to mention? Ted, can you do that?
Sure. Cash value life insurance policy, the volatility shield. Why? A perfect hedge against stock market gyration. Cash value whole life insurance versus cash value index universal life. Steve Parisi versus James Barber. Family trust and family bank funded by a family-owned life insurance policies. Tax-free legacy. Cash value life insurance policy with education. FASA and CSS. Family bank, the Rockefeller method. Tips for setting up your own family bank. Children's cash value whole life, paired with parent term insurance policy. Successor owner arrangement of life insurance policies. If I die, who will continue paying premiums of my family's life insurance? Beneficiary of life insurance policy. If I die, should my death benefits split among my children equally? And a family bank versus family foundation. What if lifetime estate exclusion is down to $3 million? And cash value life insurance riders versus long-term care, critical illness, terminal illness, and chronic illness.
Yeah. In an hour, try to focus on these 10 things. If I have time, we can do the next 20 segments because there are so many strategies we can cover. This is my personal view. I found I still stand by. I'm very proud of my creation, which is four-pronged approach. All your 401k, IRA should buy either S&P 500 or Warren Buffett stocks. Why? No fees, right? Fees very low. S&P is 2 basis points. No management fee, no financial advisor fee, 0 fees. And the compounding is very impressive. Secondly is what? They are, if you put it into IRA, HSA, Solo K, they are all tax deferred accounts, tax-free accounts. That's why it's, from tax-wise, very efficient. The third thing is whole life insurance policies. That's the third problem I want to mention today. And the last one is rental properties. Why these 4 things is important? If you look at the Warren Buffett's most recent annual report, Berkshire Hathaway's, in the past 50 years, BRAK compounding 20% on average per year. Even in the last 15 years, still 15%, very impressive. 2024, 25%. So guys, if you want to go back to your 401k account, your financial advisor account, if your returns is below 25%, it's a disservice because most financial advisors cannot add a value. They drain value out of it because they only give you some in and out. Just buy and hold 25%. Don't need to worry about anything, right? If your return below 25%, you really rethink your strategies. On the S&P side, same thing, good. But one thing I found is if you look at in the past 10 years, there are some stocks ups and downs, but the life insurance policies always give you positive. That's a good hedge. That's why called a volatility shield. The most extreme cases in 2008. Okay, Nina, can you help me mute people? Yeah. Look at 2008 when stock market down. When you're retiring that year, the best strategy is what? You borrow a loan out of the whole life because whole life gives you positive returns. So you wait out 2-3 years until market fully recovered, then you can do that. Even now, when Trump's getting this recession, remember that people said that Trump worked so hard to make stock affordable because the stock is being down 10%, right? From peak 61 basic S&P now is 57. So you're talking about 10% correction already. What do? You do Roth conversions, right? You convert from traditional 401k into Roth 401k, then you trigger a tax because tax event. Where did tax come from? Borrow loan from cash value life insurance. That's tax free. You pay that, and everything goes smoothly. When the market come back recovered, people say, "What if market always recover?" The most difficult moment is 2020 to 2022, 3 years down. I know it's hard, but if you split money between S&P and Warren Buffett gave you 26%. So this is why it's a natural hedge. I know only people say, what if this time's different? I got it, but you have to trust the system because the American economy is resilient. Technology is advanced. You can always trust the stocks market will going up because that's the only way to go up. That's the productivity goes up, right? That's how I think. All right, when Albert Einstein mentioned the 8 world wonders, the compounding interest, I added one. The 9th world wonder is diversification. It's a free lunch. If you look at the correlation table between all the 4 branches, S&P with Warren Buffett, 40% of correlations. It's decent. It's okay, but not bad and not good. But look at it, life insurance. I look at Guardian, for instance. Their correlation with S&P is 4%, right? With the real estate market is negative. That's why diversification is probably the 9th world of wonders. You can always take out some money from any accounts which produce a positive returns. So that's why these 4 things give you almost all weather, tax efficient, low fee, and decent compounding returns performance. So fire matters. You do not need anybody. You just do yourself. Okay, self-direct. Okay, you have to trust it. No need to do trading, please. Now let's move on to. I only recommend 4 cash value life insurance policies. One is a Mass Mutual. Second is New York Life. Third one is a Northwestern, and the last one is Guardian. Okay, if you want to do, gotta have this 4. People said, what about index IOL? I'm not a big fan. I'm going to show you what I mean. There are a couple of reasons. One is what? You want to diversify. When the index IOL is indexed with stock portfolio, you defeat the purpose because 50% of the assets is already in 401k, IRA, HSA, 529, is already in stock market. So you shouldn't put anything on that again. So whole life insurance policy is based on the bond portfolios, treasury, corporate. That's why their performance is totally independent of the stock market. So you need this hedge. IOL is at least 50% correlated with stock market, which is bad because you lose the diversification. So you need a positive return. Can you imagine in 2028, your IOL produces 0 returns, even negative, because you still need to pay the cost of insurance. So you cannot have that because everything else is down. You have a 0 return. That's not good. So that's why I'm not a big fan for IOL. Please listen to me. Okay. If you go to why these 4 insurance policies is important, I want to show this table. All right. Can you look at this table? This is this 4 policy whole life insurance ratings are almost highest ever. So AAA, AA plus, Moody's is AAA. It's almost equivalent to U.S. Treasuries. It's at least 1 or 2 rankings higher than banks. That's why the money put into the cash value life insurance policies, compounding tax-free, it's much more efficient than put the money in the bank CDs. There are major reasons what banks are not as safe as life insurance policies, right? We all know that. During the financial crisis, you have Washington Mutual, you have Lehman Brothers, you have, Wachovia, all coming down. But life insurance was so conservative. I only mentioned these 4. I'm not mentioning AIG or MetLife. Forget about them because only these 4 I recommend because they are highest ranking, most conservative. They only put money in the most conservative way and a very consistent compounding. Okay. To go back to the why, how they get the returns. So I'm just putting the financial report from, I think it is Mass Mutual, right? If you look at the returns, I know I'm a financial guy, I look at a lot of numbers. If you look at assets, majority of things are in the bonds, right? $147 billion in bonds. And if you go to their income, the income is roughly 4 or 5% returns. If you see $37 billion income divided by 300, the assets, but you have to divide the expenses. So roughly their return is 4 or 5%. That's why I want to see, if you want to look at this table, I'm going to send you this link, guys, which is these 4 policies, how do they perform? In the past 80 years, these 4 policies always give you returns above 4, sometimes 7, sometimes 8, depending on the interest rate, but at least give you about 4%. Why 4% is important? Everybody understands the retirement 4% rule, right? People said if you have $1 million in 401k, if you draw 4%, you can live forever. But this whole life already gave you that. Okay, I'm going to show how 4% come from my son's cash value. I want to see that. The other thing I like cash value life insurance policies, they give you the predictions, and their projections is almost identical to the actual performance. If you look at it, my son's policy is Mass Mutual, right? There are so many things on this table we can spend. I only talk about the cash value. Do you see the cash value in the first year is $23,000?
这样服侍太太的，你懂我意思吗？
People mute. Okay. The second year, 48,000. The third year, 78,000. Do you see these projections? When I purchased the policy in 2021, this is their projections. Only these 4 policies can stand by their numbers. Okay. I'm going to share my son's policy's actual performance for the past 3 years. Okay. You look at, I downloaded my son's policy, every year statement, they have annual statement. So this is the year 1, which is the first time I purchased, right, $29,000. And if you look at, this is 2023 is 49,000 cash, and 2024 is $77,000 cash. And this is this New Year's annual report. Do you see 77,000? It's match this number. If you go back to the prediction they have, my prediction is what? 23, 48, 76. So the real performance is even better. They said is even better. That's why guarding cash value and look at Mass Mutual, right? I just compiled this table showing. That's why I trust these 4 companies. They stand by their numbers. They don't cheat. And this is illustration back in 2021. My son was 18, 19. 2022, 2024, you see the numbers? Almost spot on, or even better. That's why this give you 1% guarantee. I like guarantee. Stock market is not guaranteed, but they did this. Okay? And I want to do that for next year, continue. Look at Kevin's IOL. The first year is already down by $4,000. Second year down by $7,000. That's IOL. That's why IOL, on the surface, the projection is very rosy, very optimistic. But in reality, they overpromise and deliver. Do you see that? Look at a nationwide IOL, even worse. Okay. So I'm going to tell you guys is IOL is good, but it's really not that good. Even market going up, they still give you mediocre return. So if you guys have an IOL, you need to talk with your agent. Tell them, give me your annual reviews. How many Chinese agents sell the product and disappear from you? You cannot have that. So if you have IOL, I want you to talk with James Barber. Okay, he's my agent. You can find his YouTube channel. He charges you $60 an hour consultation fee. You can review 2 policies. It's way worth it. You give him your annual report of your IOL and showing initial projections and try to compare. And 99 chances is the fees is too high or you did not pick the right rebalancing of your index. That's why IOL is a highly attentive product. You constantly need to rebalance. It's annoying. I would rather buy all my stock market in Warren Buffett stocks, S&P 500, and for my cash value life insurance, just whole life. I guarantee 4 or 5% returns, and it don't even, So when you have IOL, talk with James Barber. Okay, you mentioned my name. He's very professional. And in terms of the whole life, I highly recommend Steve Parisi. Okay, I have an even talk show with him. If you guys want to watch my talk show, I'll send you the link. He every week, every Friday, he invites some financial advisors. I'm one of the speakers for his talk show. Okay, I share all my views, and we have Steve Parisi is one of the best in the nation in the cash value whole life. You should talk to him, and he's published a book, so buy his book. Okay, so these two guys, and probably if you want to work with Steve, you talk to me, and also you can go to his YouTube channel, find out, just mention my name and schedule an appointment. Again, let me go back to Chris's why whole life policy is not your old school whole life policy. Yeah, people mute yourself. Nina, help me mute, okay? Ted, can I give you a co-host because people, I don't know, okay.
Sure, that's no problem.
Yeah, I'm not a host. I couldn't even go to the right. If you feel, all right. So this is the policy I think the most efficient way to design. Your cash comes from 3 tranches, $28,000 per year buy a whole life. Why buy young people's whole life? Because young people cost insurance cheaper, right? Much better than I'm 55. My son's 19, he's cheaper. So $28,000, $2,800 buy a $500,000 whole life. And another $2,800 buy a $1 million term. It's a 1-year term. 1-year term means what? Insurance company said if you die within this next 365 days, they give you $1 million. But for young people 19, based on his health, based on his lifestyle, is the chance of being, have this tragedy is almost 0. That's why you only buy a 1-year term at $2,800. And after this first year, this is renewable. The second year still pay the same fee, still $1 million is renewable. And that's why the whole life guarantee the whole rate at the time of the underwriting. That's why you don't worry about, for me, for Ted, if you buy term every 5 years, they double the premium, makes so unaffordable, right? That's why we cannot do that. You can only buy within the policy is a 1-year term rider, meaning the premium is prefixed throughout the life. You want that kind of things. You don't want change. Okay. And then the third cash value is what? This the cash, the $22,000. Why this strategy is 3 components is efficient? The first year your cash value is 23. You put in 28,000, right? Remember 22, 28 plus 28 plus 22, that's 28. So 80% cash is recoverable. That's your efficiency. And you're fully recovered at roughly at year 4, year 5, year 6. Do you see? 28 times 6 is 168. And your cash value, because of natural compounding, is 169. So your break-even point is 5 or 6. Most cases is good number. If your old school cash value life insurance getting break-even at year 10, that's way not efficient. You need to rethink. That's why old school cash value life insurance doesn't work anymore. Life changed, technology changed, design changed. You have to use this way. You want to break even at a year 5 or year 6. That's the minimum. Okay. Why this thing matters? If you look at, I'm going to put a lot of numbers. Sorry, I'm a financial guy, right? I can transport his numbers into Excel. And the whole point is we'll calculate IRR, internal return for any policies. There are 2 IRRs we calculate. One is pure cash value. The other one, what if my son died? They have a bullet pay $1 million death benefits coming. So you have two ways, assuming my son never die, okay? And this column is IRR, okay? Do you see that? How do you calculate this return? Is your current year's cash value divided by prior year's cash value base and the annual premium you paid in. Okay? That's how you calculate the simple year by year return. Most cases is 4-5%, 4 to 5%, right? Sometimes 8, I don't know why. Why this number is important? Because this is equivalent to the AAA American corporate bond yield. Okay, because life insurance companies have millions of policies, they have their durations, the vintage of bonds from 1960s to 70s to 80s to 90s to 200. That's why they have a whole spectrum of bonds, different durations, different yields, because of different tranches. On average, they can produce 4 or 5% returns, give back to you. Why this number is important? This is guaranteed, right? This is guaranteed. And when you take money, what do? You borrow a loan out of it. What's the loan rate? People say, what about the loan rate? Okay, let's look at my son's policy, the loan rate. People always ask me, what about you pay the loan? Come on. If you're already tax-free, if you want to pay loan rate, just deal with it, okay? Look at the Chris 90 policy. The loan rate is 5.72. Do you see that? Why this number is important? Do you see loan rate 5.72? Why this number matters? Because on average, your compounding is a 4.7%. When you borrow a loan against your life insurance policies, you are not losing your compounding. What life insurance company does is they loan the money from their own pocket money, not your life insurance cash value, from the pool of general accounts. So Guardian give you $10,000 as a loan, charge you 5.7% rate, and your cash value is unprotected. Is untouched. It's intact. Still compounding at a 4.7, still fully compounding. So your net cost of insurance is 1%, the cost of the borrowing, because 5.7 is they charge you, and the 4% is your compounding. Your money never lose value; it's still compounding. That's why your net carry is negative carry is 1%. It's much better than what?
一颗咳嗽药要不要？
咳嗽药我要，你给我点咳嗽药，我也想要。All right, so guys, so make sure this kind of policies is so efficient because your money is still in the cash value policy, still compounding full speed. And you never worry about this money go away. But if you go to your bank, what do? You take a loan. The loan is prime, it's 9% already. And if you take a cash from the CDs, and you lose the CD interest. That's why banks is probably the most inefficient way from a tax perspective. If you look at Biden, I will mention Biden's tax return. So this is Biden's tax return. Do you see what? Okay. Ayana, can you see what's the problem with Biden's return? Ayana, are you there? Can you see this? Give me some feedback. You are all my tax clients. I want you guys to comment on that.
Okay. Well, it looks like you've.
So I lost you. So do you see that in his return, he has 39?
Yeah, it said host has muted me. Sorry, I got unmuted. Okay. So it looks like it's about 39K of tax exempt interest.
Tax interest, taxable. So
taxable. I'm sorry. I'm looking at 2A. Okay, yeah. So it's taxable interest.
Yeah.
So that's under ordinary income rates. Yeah. I see the problem.
What's the problem? Because he has a $480,000 taxable income, meaning what? His tax bracket is high, 32%. So $39,000 is bank CD interest. You have to pay 32% federal income tax and 5% state. 37% taxes is there. That's the problem. Because bank CD only give you 4% return. You pay 40% down, so your net effective rate is only 2.5. The inflation 3%. So you are losing money. This is the dumbest way. We have so much cash in the tax returns. You are losing money every day. You give you false of security. Bank give you a guarantee FDIC. I got it, but life insurance is more secure than FDIC. Please trust me. And the second problem is what you are open for litigations. If Biden have any problem in litigations, lawyers can access his CD, his return. Oh, Biden had $40,000 CDs interest. If you think the rate is 4%, he had $1 million cash in this WSFC banks. Okay, what do you mean? And the lawyers were going to grab this cash. So you expose yourself to litigations. What if Biden moved this cash, put into Mass Mutual, right? This Biden's still good. Put into Mass Mutual insurance, the cash compounding inside. There's no 1099 interest, no 1099 dividend, no Schedule B, no Schedule D. That's nothing, because this is a private contract. Your money disappeared. Nobody knows that you have $1 million. You are all hiding here in the cash available policies. When you need it, take a loan. The loan does not produce any tax forms. You can make all the private contract between you and family members. Nobody knows. That's the beauty. That's why it's asset protected. Life insurance company is the most secretive, confidential contracts, right? And second is your interest is compounding 4.7% or 4 whatever percentage, and without paying any tax. This return is your effective tax-free return. Is equivalent, if your tax rate is 30%, is equivalent to 7 or 8% CD. You never get a CD like this high, right? That's why cash value life insurance is the most secure, efficient, and private way to stack up your cash. I'll pause here. Just digest. All right.
Hey, Mike, question. So if the tax equivalent yield is 7.8, then isn't the loan at let's say 5.3% that you showed? Doesn't that mean this is a positive yield?
Well, it could be positive yield. Yep, you have a good point. Now I'm going to do a tax return for you guys. Good point. I'm going to use a tax form to do a return, okay? Assuming my son is going to buy a rental property, right? He want to buy a rental. My son's Chris, and he and his wife want to buy a rental. What do? What you put a Schedule E. Can you see my screen, guys? I hope you can see. All right. In this, everybody understands Schedule E is for rental properties. If you go to Schedule E, there's one line called Other Interest. Do you see line 13? So you have a 1098. It's a mortgage interest because you borrow a loan, but the down payment, because Chris is only 20, he has no down payment. I gave him money, but my money is not from where? From my life insurance policies. So the most frequent question people ask me is, can I borrow a loan from life insurance policies to buy rental? Can I deduct that loan interest from the life insurance company? The answer is yes. I know there are two schools of accountants debating all year long, okay? But there are two people I believe they are legit. One is a rich dad, poor dad accountant. His name is Tim. Cindy sent this guy's the book to the Cindy to the team, and this accountant wrote a book about the cash strategies. Specifically mentioned it's legal, it's legit to deduct your life insurance policy interest because you are putting the money into the investment. The other person supporting this argument is Barbara Wetman. I mention this book all the time, right? Barbara Wetman, in her book, specifically mentioned is the taxability, deductibility of loan is not determined by where the money come from. Life insurance, your home equity, whatever, is determined by what the money is used for. If this cash is used for income producing business entities, then that interest is deductible because you produce interest, produce profit. Okay. okay, I'm going to put in $20,000, $50,000 down payment for my son. And do you see that? Borrow life insurance loan, 45,000 as down payment at a rate of 5%. I produce $2,200 interest for my son because he need to pay me back this loan. That is a business loan, nothing different from bank borrow from bank. He's borrowed from me. I'm his family bank, and he need to he'll deduct $22,000 or $2,200 interest. For me, what does it mean to me is I need to report that to my interest income, to my tax forms, because this is my interest income, right? People said, "Oh, Mike, your tax return is 30% federal plus 5%. How can you deduct this?" The answer is, if you go to ChatGPT, when I report this $2,200 interest income, I immediately file another form called 4952, called the investment interest expense term. What does it mean? Meaning, on one line, I report to IRS, I have a $2,200 life insurance home equity loan interest for my son because he paid me back. It's reportable income, yes. But on the other side, because this is my loan come from life insurance, I have a cost of borrowing at a 2,250. It's a wash. So that's why I put it one line interest income, another line interest expenses, and at the end of the day, it's net. That's why Ayana answer your question is, I have a zero tax burden on this income. So this I have a positive carry. Okay, because my son get deductions. I did not get a deduction, but as a family, we have a profit because we have the one deduction on him, and I have a zero tax impact on my return. I totally follow the rules. So that's why borrow a loan from your cash value to buy houses, buy a car. Why buy a car is good? Because you're business. What to do in business? You can deduct your auto loans, the interest, right? Nothing different from Capital One auto finance, because that interest is deductible. Same concept. Okay. But again, you need to create a loan contract, right? You cannot do it randomly. I have to write a loan contract with my son. I'm lending him at a 5% rate, whatever rate is 5.7%, and he had to pay back within 10 years. And you have to do this legitimately, okay? Otherwise, people think IRS think you don't have a legal what do you call the non-recourse the loan clauses. Make sure it have legal document to support you. That's why when you do these things, talk with accountants, because you cannot don't do things by yourself, because you only know what you know, right? You have to think of, if I have this loan, I need loan agreement. You have this paper flows, okay? Money flows.
Mike, the money that you borrowed it's from the insurance? It's from the whole life?
Mm-hmm.
You lend to your son?
Yeah, absolutely.
And and you have to pay the interest into your own life insurance, or is there any deduction of your return?
My son pay me interest. I pay the interest pass through back to my life insurance. That's why, right? Because my son is renting his house out, right? He's making rental income. He'll pay me interest. I pay the interest just using his money. I'm a pass through. Okay.
Right, but does this borrowing impact your whole life value or no?
No, because like I mentioned, that life insurance company use their general fund to give to me, does not touch my money. My money is still compounding full. That's the whole point. That's the
No,
yeah.
just stop touching longer.
People mute yourself. Okay.
Yeah, I did.
All right. So now I do that if I sound, but what's the most efficient way is what? I know, I hope my son never die, but if he die, you get a, if you look at the policy of assuming 40 years from now, he's 65, he can retire. If he died at the time, he'll leave family $6 million. If he does not die, he's still living, breathing, kicking, he has $3 million cash. That's the beauty, is you can always have that. But again, these two monies is mutually exclusive, meaning what? You cannot double count. For instance, when Chris died at the age of 100, so he have $11 million cash and $11 million death benefits. Meaning when he died, his son, his family will get $11 million. they only give you the higher of these two. So this and these two numbers, insurance company give you the higher, but not both. Okay, that's why insurance company wish people to live as long as possible. Why? Look at it. If by the time 100, the cash premium compounding inside the policy is already fully substitute or replaced that benefits. Mass Mutual, New York Life, they have a zero liability obligations because all the money you pay back is your own money because this is your compounding, right? That's why life insurance companies, they want people to live as long as possible because they have lower obligations. And the worst situation is Chris died at age 19. Why? I only paid in $48,000, right? $50,000, and life insurance company have to pay me back $1.9 million. So that's the worst situation. For me, my internal return is 10,000 because I only put in 50,000, I get 1 million, right? Think about it, do the math. But life insurance doesn't want that. They want you to live as long as possible because the longer you have, the more compounding they have, the less burden to life insurance policies. That's why I think this is life insurance company and us. We are in the same boat. We want people to live long, compounding more, and everybody's happy. Okay. Now people ask me, why IRS give you such good benefits? Tax-free this, tax-free that. Why? Why IRS treat life insurance is so tax-friendly? I have so many different theories or conspiracies, but there are a couple of reasons. One is what? Many lawmakers, they all have policies, life insurance way back when, right? And they want to protect their families. They don't want to tax it. Lawmaker is selfish, you know that. The second reason is what? Life insurance companies are most, I call it a powerful lobby group. They told IRS, they told Congress, you can do whatever you change tax laws, do not touch life insurance. So they are most powerful, most, I call it ingrained lobby group in the country. Okay, much stronger than Doge. Okay, and number three is what? IRS said, you put in money as a premium, it's post-tax money. You don't deduct anything. So when you get the money out, it's tax-free, it's fine. So you only tax once because you already paid out of your post-tax money. That's why they feel you don't need to tax you more. So IRS feel, you deserve that. Number four is, do you see the premium, the first year premium? I paid $28,000. Life insurance agent, they will get about $5,000 premium for first year, meaning 90% of this, maybe 50% of that. This premium going to agent, the agent need to pay Social Security tax, FICA, income tax. That's why IRS is happy. They get money not from you, but from agent, because all the life insurance agents they still need to pay, get a 1099 to pay taxes. So IRS get taxed anyway. And 100% of the life insurance companies make money. You can see why their yield is positive every year, because they are so conservative. They always produce the yield, and life insurance policies produce profits, and IRS tax these companies as a corporate tax, 15%, right? They have employees, they have and also they have to pay corporate tax 15%, and state maybe another 5%. That's why they still get the money. You as an insured person do not pay taxes, but so many parties pay taxes. Insurance company, the agents, right? That's why to IRS, they're happy. They're already happy. Okay. All right. So we talk about that's why this is the most efficient way. When you go back to your policy, try to see, number one, am I making break even at the year 5, year 6? If the answer is yes, that's good. If year 10, it's not efficient. You have to rethink, talk with Chris Parisi, okay? Number two is, am I producing the cash flow every year matching the illustrations? If the answer is no, you need to talk with the people. Look at my Northwest Mutual. I mentioned 4 companies, right? This is my policy. Year 3 is spot on. $10 off, right? $13 off. I'm going to, every year I do the workshop, same year. Every year I roll forward my projections. I want to show you these 4 companies done by the numbers. They never lie. Okay, they've been around for 180 years. They don't lie to you. Why they lie to you? They have millions policy holders. So for them, This is your foundation. This is your most secure, sacred money. They always promise deliver what they promise. Look at this, right? And this IOL, so ugly, so ugly. Mass Mutual, spot on. My New York Life, yeah, my New York Life for some reason is not efficient. You see, I'm probably like $800, 5% off. Sorry, I'm not happy about that. But New York Life is always so arrogant. Just deal with that. So not a bad situation, but maybe that's the way it is. So far, I'm happy with the Mass Mutual, Guardian, and Northwest Mutual. Okay, I'm not happy with my IOL at all. So if you have IOL, talk with James Barber. You need to review, because how many people buy this policy, just forget about it. Sitting there compounding stupidly for years, you found that the number is so mediocre, make heartbroken. Okay, please wake up. Download all your statement, like follow my track, do all the cash value comparison year by year, and curse your agent. Why you give me this crappy policy? Why you do this to me? Ask them. Okay, let's move on to these two books, right? The Volatility Shield, David McKnight. Definitely read his book. It's a very interesting book, perfectly matching. And Nelson Nash, he's the godfather of the infinite banking. Definitely do that. I think the most, in my view, I call the ultimate condition of banking ourselves. This is my number 27 in the strategies. Probably it's the one David Nash mentioned, Nelson Nash mentioned. I think it's totally changed the mindset, guys. What do we do in our current life? What do we do is what? We earn W-2 income, we pay tax, and after tax money go to the bank. We pay mortgage, we pay car loans, we pay credit card loans, we have nothing left. Probably, 10% left. We put in some 401k, whatever, 529. That's our, right? That's our life. Money in, money out. 90% of American families only have, 1 month of cushion. One single accident, one single layoff by Doge, you're out of whack. But can we change our mindset? Your money coming in from your W-2, your hard-earned money, do not go to bank. You pay your whole life premium. The premium is based on our 3 tranches, right? A small whole life, a 1-year term, and 80%. Can I mute this guy? 80% money go to my my cash value. So your money does not go to bank. The bank immediately go to premium to pay your life insurance policies. All your family members, you, yourself, your wife, your husband, together. And when you need money to pay car loans, pay mortgage, you borrow a loan from the cash value life insurance rate at 5%, whatever percent it is. Because your premium is still compounding full speed. Your net borrowing cost is sometimes is negative, sometimes is 1%. So your value is always compounding in a tax-free way, never touched. And you are using the insurance company's money as your bank. That's called a bank on yourself, because bank against your life insurance policies. You totally dumped Wells Fargo, totally dumped Bank of America, because your CD doesn't give you anything, give you negative returns. Put the money in the premium, and you draw a loan to pay your credit card, mortgage, car loan, whatever it is, student loans. That cycle is more efficient. I know it's kind of hard to fathom, but that's the way it is. That's the way it should be. Okay, you protect the cash, compounding tax-free, and you borrow a loan at a very reasonable rate. You don't need to deal back. The banks give you. My son want to buy a car, and we have to go to Federal Credit Union to get a loan. And the banks, oh, you have mortgage, you have this, we cannot give you a loan. What the crap? In the future, you don't need to beg the bank show your W-2. You just call your insurance company. I want to borrow, take a loan. they never ask you questions, never check your FICO score, they never ask you W-2 pay stub. They just give you a loan. Why? Because your debt benefits is their guarantee. So you collateralize your life against your loan. Life insurance companies have they don't care. They don't care. Yeah. Okay. So that's the concept. Bank on yourself I think it works. It works. Especially when you in a tax efficient way to do this. I think the traditional banking way is dead. The one that your school teach you, the one the IRS teach you is dead, because you don't look at Biden's stupid return. He's so you have negative returns, and the whole world see you have bank CDs. You just expose yourself to so many risks, right? All my family values in the casual life insurance. Nobody knows. Only my family knows, right? Totally protected. When you talk about asset protection, this is the best protection, because life insurance company never release your name to anybody. Why? Court, you cannot do that. They cannot force you to give up, because why? Life insurance company said, this life insurance product is to protect Mike and his families. How can you force me to give money to the litigator? You are sacrificing or jeopardizing Mike's children, grandchildren. They are not doing that. That's why it's a well-protected vehicle compared with the CDs. So CDs is the bad way to do that. Pay taxes, you expose yourself, nothing good. All right, so we mentioned do the comparisons. I want to move. Here's another problem is, life insurance company in my family, we could have easily, after so many, Chris, by the time he has $800 million, he has 4 policies. Can you imagine 80 years from now, he has $40 million in his policy. Kevin, $40 million. Alicia, $40 million. Sasha, $40 million. So the family have $100 million. We have a problem. The problem is what? Because if the estate tax is coming in, this money will pay 40% estate tax. Income tax free, but estate tax is not free. So that's why I have to give you another way out, which is family foundation. So before Chris died, you have to calculate how much estate tax he has to pay. If by the time, remember we mentioned the Chris policy, by the time he's 100 years, let me see. By the time Chris is 100 years, he has $11 million for this policy. Assuming the lifetime estate max is $3 million exclusion, meaning what? He has to pay tax on this $8 million, because 11 million minus 3 is 8. $8 million taxable by how many percentages? 40% of federal estate tax and 5% state, that's 45%. Very inefficient for him to die. So what you do is what? You take out $8 million cash from his policy. You only leave $3 million today. You take out $8 million, you donate into your family foundation, Smart Life Foundation. Because it's a charitable giving, it's tax-free, right? And the foundation is non-profit. You compound inside by Warren Buffett stocks, by S&P is cash-free, tax-free, because non-profit have. That's why you split your money within the 3 million lifetime exclusion in life insurance policies. You borrow a loan, anything excess, you donate to your own family foundation. The money never go anywhere. That's why no taxes. Both are private contract, because nobody knows the family foundation have this money come from their son. Nobody knows, because that's your thing. And it's all protected because no lawsuit. Your foundation doesn't kill people, right? Doesn't drink and drive. That's why this money compounding tax-free. I think that's another strategy for you is if you have a lot of money, a lot of rental properties, a lot of life insurance policies, use this way to split. The split is so easy. Forget about ILIT. People tell agent tell you all the ILIT is crap. Number one, it costs you $2,500 to set up ILIT, right? This is already bad enough. Number two is, but then by the time your cash value into the ILIT, you cannot get a loan out of it because you lose the control. It's irrevocable. I would rather keep this policy still in the irrevocable. You take a loan because you are the owner. The loan go to life insurance policy, go to family foundation, and you bypass ILIT. Right? This is another way to do that. Okay. Okay, I think we talk about the strategies. I know sometimes hard to comprehend so many knowledges, but I just tell you, if, for instance, if you are too old or too well or too sick, cannot buy policies, buy a policy against your children, right? Young people. When Sasha got a scholarship from college, I immediately bought a policy for her because in the eyes of life insurance companies, scholarship is treated as earned income. So she get a $2 million policy right from nowhere. And I own the policy. And because Sasha is only 18, her health is so condition is much better than me. And her cost of insurance is so low. That's the most efficient way is not guarantee life to you. You should insure life against your children because they're 18, 19, 20. They have the best body to insure. Okay, all right, I'm going to answer questions now, almost 10. Okay, any questions, people?
Yeah, Mike, I have a question. When you're putting money into your life insurance policy, the 2,800 is for the premiums, but then you said you put 28,000 in a year. How did you come up with the 28,000? Is that part of the policy or?
It's my personal Ponzi scheme, guys.
And that is just money like, you can't, it's like saving,
Yeah, remember
after tax.
I bought four policies, right? What I did is a domino. I put in $28,000 from Chris. Do you see 28 here, 28, and I have cash value $23,000, right? And the second week, I immediately borrow a loan out of it, 23,000 full, and I started to fund Kevin's policy. Kevin's policy is smaller than this, but I only added in another $3,000 because I borrowed a loan out of it, and I found Kevin's policy with the same structure. When Kevin's policy is funded, I third borrow policy against Kevin's policy. I take a third loan. I started fund Alicia's policy and Sasha's policy. I just Ponzi scheme myself. Total legal.
And when you say you borrowed a loan to fund the second life insurance policy, that $23,000 is still invested and compounding. Is that correct?
Correct. At 4.7%. And my loan is 5.7. Yeah, I pay net 1% interest. For me, I don't feel bad at anything. 1%, come on.
Mike, can you, I missed a little bit. Why is it whole life on your kid is better than on yourself? Just
Cost of insurance. I'm 55. I have so many doctor visits. And people say, why you do this? Why you take medicine? Life insurance company ask so many intrusive questions, so annoying.
but the beneficiary gonna be if you buy the life insurance on yourself, the beneficiary will be your kid, and if you buy the life insurance on your kid, the beneficiary will be their kid.
Nope. The beneficiary is nobody. The beneficiary is my family bank. Family trust. All the life insurance policies doesn't benefit anybody. Go to the family bank. You need to buy this book, David Phillips, The Family Bank Strategy. Okay.
Working class life insurance.
The life insurance policy never split among the kids, because if you do that, this kids just pray you die as soon as possible. They will get money around. You don't want that.
Can you buy the policy for the grandchildren?
Absolutely. Next Nelson, he has 42 policies. Some are his kids, some his grandkids. You can buy policies against your boyfriend, your son's in-law, whatever. Yeah, perfect, fine. That's the best way to do that because you own the policy, you fund it, and use their cheap body. Sorry, not cheap. Use their good body. Cheap, yeah. And that's why when you go to this, the concept, we need to change the whole mindset, guys, because this thing is It's so convoluted. It's just unconventional, but that's how rich people do this. For instance, if you look at my number 7, I own the policy of Chris. I'm 55. He's 18. By the time I'm at 85, I have dementia. I forgot the premium. I start to lose memory. I could, right? Ted, do you see old people have this issue, right? Dementia, whatever, right?
I'll
Parkinson.
say for sure.
Yeah, that's the problem. What do you do? You need to have a successor owner in your policy. What is successor owner meaning what? Meaning, if I stop functioning mentally or physically, or if right, and my accountant or my financial advisor or my insurance agent will take over the premium payment duty to my son's policy because my son is only 40, so he's still compounding. I cannot lose this compounding thing, right? So that's why the successor owner got to be in place. He's your second line defense. Even I'm not functioning, and you have your professional do it. Who's a professional? Certified financial planner, certified life insurance underwriter, because these guys know how to do it. They have a schedule. You give them all your policies, due date, phone number, policy number, website login, and they pay that all for you. Okay, so that's why successor owner should be corporate, because Rockefeller has been 5 generations. Nobody there doing this policy, but their New York Life agent always pay because they're corporate. They are forever existing, and they take care of their policies generation by generation. When Rockefeller 6th generation now, their policy benefits $5 billion because so many compounding. Number 8, beneficiary, you should not give to children, because if you give to children, you create trouble. Remember, discourage, distrust, dissipate, disappear. You don't want these. You want to consolidate the money, the beneficiary should your family trust. So who is your trustee? The same guy, the successor. He managed your money, go to the policy, and he managed the money as a beneficiary. So the trustee will use the death benefit, $11 million from my son, to do what? To buy more policies for his children, for his grandchildren. So this is how the money compounding perpetually. So that's why family trust benefit all the policies. So they protect, perpetuate, and perform. And anything over lifetime exclusion go to family foundation. Who is your family foundation member? Your grandchildren. They are board members. You still have CPA do tax returns. That money, don't worry, because then money always protected. It's tax-free. IRS will prohibit you take money for your personal pleasure, right? This is a non-profit. Very careful. Everyone understand you cannot take money out for non-charitable purpose. Understand? I think the number 10 is also very good, because all my policies have 3 生前利益，对不对? Not death benefits, called life benefits. So critical illness, terminal illness, chronic illness, 3 times I can get the money up to 50%. Same thing. Remember, Chris have in assuming by the time Chris had dementia, he's 80, 90 years old, he has dementia. He's still kicking, and he's going to need a lot of long-term care. What he do is what he called New York Life or Mass Mutual, whatever. He said, I have dementia. No. His daughter or whoever it is called this, showing a medical certificate. He has been diagnosed with dementia. Blah, blah, blah. He can borrow up to, the insurance company will give half of this money out. So $5.6 million as the life benefits to Chris or to his spouse. Why this is good? Number 1, tax-free, right? Same thing, tax-free. Number 2 is what? Because Chris, his family used this $5 million life insurance payout to do what? To hire a nurse. Because you hire a nurse, you buy a wheelchair, all these medical deductions. So these are deductible medical expenses can go to your Schedule A, itemized deduction. Because Chris' AGI is so low, because everything is a Roth account, he has no zero AGI. His AGI is very low, some Social Securities. So anything above 7.5% will go to deductible Schedule A. And in that case, you get a tax-free money from New York Life, and you get medical deductions on your Schedule A on the returns. You double dipping. Totally legal.
Mike, can I just make sure I heard you right, that the payouts from a life insurance policy are tax-free?
Yes, because you take care of this your life benefits. Yeah, you need medical critical condition, you get cancer, you need a therapy, you need a chemotherapy, whatever it is, and the life insurance will give you the money. IRS will not challenge you because you are still living, you're not dying, and you just use the money for medical, totally fine. That's why good stuff. Can you
Awesome.
imagine your daughter? You pay your daughter, right? Your daughter take care of you. They get paid. She'll file schedule age, pay some FICA, but everybody happy. Life insurance company can feed the whole family while you're still living. So the people wheel you chair around the lake, they are not crying. They are happy because they are wheeling over $5 million cash.
Mike, in other scenario, if I want to take the money out of it, is that has to be in the form of a loan or can it be
Unless you have cancer, you can take this illness thing. Otherwise, it will be loan. Yeah.
and how's the rate is this determined, the borrowing rate?
The rate is a AAA bond rate. That's why if you look at my son's rate, is the loan is 5.2%, 5.72%. Do you see the rate? Yeah. Why 5.7? If you go to Moody's AAA corporate bond rate, it's 5.7. Yeah. Our insurance companies are very reasonable. They don't overcharge. I know home equity. I don't know, Ted or how much you pay home equity rate.
Uh, I don't have a home equity loan. I mean, my 401k loan is 9.5.
See, 5%. 401k loan is 9%. Home equity is prime is 7%. Credit card loans is 20%. Car loan is 7%. It's all bad loans. This is the most efficient way to do that. It's low rate, and also you can deduct on your tax return because you put in rentals. You buy a car to deliver pizza or Uber. These are all business loans. It's interest deductible. You win multiple times.
Just
Guys, don't challenge me. This life insurance companies. That's the best thing people should use. Cash is compounding without touching. Your loan is interest deductible. What else you want, guys? What else you want?
This is great. And back to, the family foundation, do I need to set up the family foundation as a beneficiary at the beginning of the whole life, or it can be later on?
You can do really driven by the family situation. If I'm Joe Biden, I cannot leave my policy to to Hunter Biden. It's a disaster. What I do, I donate to my family foundation. Money is well protected for the futures. Do good things, do humanitarian things, charitable things. Not going to Las Vegas to do some stupid things. Yeah.
And do you need a lawyer to set up the family foundation, or how's that set up?
Set up a consult with me. I'll do it for you.
Okay.
All right. Well, you need payback loan. Yeah, you need payback loan. Come on. You need to leave a clean things to next. Yeah, just pay back. Where it comes money pay back, make money. Do the rentals. Right? Use your rental income to pay back. Don't challenge me. If you borrow a loan from a bank, do you pay back? You pay back, right? If you borrow a loan from a credit card, you pay. Yes. Nothing different from life insurance policy. Just pay back. For a 56-year-old man with no kids is still efficient to buy a whole life against your whole life? Um, that's a good question. I would rather to if you have no kids, it really depends on what you want to do for life. If you just want to have medical coverage, maybe long-term care is more efficient because you have really no legacy to think about. Probably I don't think about it. Yeah. Whole life good for young people only. I think is good for anybody. I bought my policies. I told you my policy is not efficient because I'm old, right? Nothing can do. That's life. Let me show you my policy. Okay. Guardian. My policy is not as good as Chris because that's life. All right. Do you want to see my policy? Okay. Luckily, I'm a yoga maniac. My health condition is the best. Most people may not get this rate. I'm 51 at the time. I was 51. I got a preferred plus, the best rate, non tobacco. And my rate is 6,000. Do you see $6,000 to get a $1.9 million the coverage. For Chris is what? For Chris, let me see Chris. Chris is $5,600 cover 1. Oh, equally. Okay, roughly the same. My policy at a year 5, because I put in 60 because I put a lot in order to do that. So this is my policy. I break even at if you do that, I break even at a year 3, year 4. Year 4. You see, my year 4 is break even. 264 is my total outlays because 64 times 4, my cash value is 266. So my break even year 4, very efficient. But again, how many people can get a preferred plus at my age? Good luck for you. Sorry. If you don't go to yoga every day, you may not get my rate. Yeah. Because high life income, they are so picky. For man, 50, that's so picky. So if you don't get a good rate, I would rather just buy kids. Forget about yourself. Why? Because it's your money. You should get a more compounding than, right? Doesn't matter you against whose life. As long as life is cheap, that's all that matters. Because the cash value matters. Mike, for number 10, what is your opinion buying asset link long term? Yeah, I'm not I have long-term care policies because I only pay $2,700 a year to get a I buy life insurance. Yeah, do that please. Yeah, long-term care is always good because you want to leave good money to your next family bank. You don't want to take out money from life insurance policy. It's more like third line defense. Long-term care policy, please buy. It's good stuff. Should you buy a policy for kids as young? Yes, you can buy at the age 1 year old, 2 year old, doesn't matter. How do we calculate the agent fee when buying policies? You ask them how much you get from my policy, right? The best way is ask Steve Parisi and James Barber. These two guys are, I call the most professional, the highest ethical standard. You should do that. Forget about the WLP people. Okay, sorry. Well, you need to buy a payback loan. Yeah, I talk about that. What else going on here? Why people still ask this question? I mentioned it, right? Because your life insurance policies, you need a asset compounding totally independent of the stock market because your 401k, your IRA is already in Warren Buffett stock. IOL defeats the purpose because they are indexed with stocks. Forget about it.
And Mike, sorry, for the Connecticut resident, is there any specific life insurance company is better for a certain state resident or there's no?
Because all New York Life, Guardians all cover all 50 states, even some foreigners. Don't worry, doesn't matter which state. Yeah, they all covered. Yeah. If you really want to diversify, I also pick Penn Mutual. I pick Penn Mutual, but again, I only cook I only eat what I cook, right? I told you guys, and I have all the policies from all the major companies, from Mass Mutual, from New York Life, FNG, Nationwide, Northwest Mutual, and Penn Mutual. I have all of them. So far, only 4 companies I trust. I just mentioned this 4. Everybody else, good luck with you. Okay. Family Foundation. All right. What's this? Should I buy instead? You should buy both. So every policy, I think all the financial assets is a pros and cons. I never underestimate or trash any policies or any instruments. 529, you should have it because they have such a good way to compounding in the equity market, you get tax deduction from state tax returns. Do 529, please. 529 is such a beautiful thing because 529, the money, $1 million compounding is outside of a lifetime estate. They don't tax you. Even if you have 30 million, doesn't matter because it's not calculated into your personal estate. Okay? Why? Because benefit for children's college. So 529 should be used 529. Do not. Everything here I mentioned, education savings account, UTMA, IRA, Solo K, HSA, Family Foundation, these are all good stuff. You should have all of them. I have all of them. And the rentals, please. Yeah, please. Okay, let's talk about, okay. Katina, can you read the number 21 to 30, Katina? I know I try to pick up people randomly, I'm sorry. Can you read? All right, Katina not here. How about Joe or Haiti? Are you there? Hello? All right. I don't know who is here, but pick some people. Any volunteer? Anybody want to read this?
I'll do it, Shawnette.
Okay.
Number 21. Biden has 800,000 cash in CD accounts. What is the issue?
What's
Am I
the-
just, are you going to answer each of them or am I reading it all the way down?
Yeah, you can answer that, please, Ron. Yeah. So what's the issue with this one? CD or taxable income, right? You have to pay tax. And everybody know you have cash, you expose yourself to litigation risk, right? And okay, number 22, please. Yeah.
What can Biden do better to avoid paying taxes on CDs?
Yeah, we talked about that already.
Okay. 23. If Biden is too old or frail, how to buy cash value life insurance?
He should buy insurance against Hunter Biden, but the insurance company will treat Hunter Biden as uninsurable because he's a drug addict. You can only buy against Hunter Biden's daughter, grandkids, because they're pure, they're pristine, they're clean. Yeah.
Number 24. Can Biden own and pay in cash value life insurance policies against his grandchildren?
Yeah, absolutely, yes.
Okay. Number 25. How much cash value life insurance should Biden buy?
It's a family decision, right?
Mhm.
I think my takeaway is the cash should be split 25% in each bucket. 25% on Warren Buffett stock, 20% S&P, 25%. 25% cash in life insurance, 25% in the equity rentals. So this is your split.
Hey, Mike, isn't there a limit on how much you can buy insurance if it's a minor?
The minor is driven by parents. Parents limit is driven by income. For people my age 50, they can life insurance limit is 25 times my W2. If my W2 is $20,000 and my limit is $5 million. So that's a limit for me. And for children is 75% of $5 million. So in the most, if I'm healthy, I can insure 5 policies, total $5 million. And my children can insure $3.75 million based on this ratio. Yeah. All right, Shauna, continue.
I can't see the questions.
Sorry.
That's okay. I think we're at number 26.
Six.
How to calculate the internal rate of return IRR of cash value life insurance?
Yeah, the one you do is what? Next year's cash value divided by the prior year's cash value with your premium contributing in. So that's your policy. So roughly is 4 to 5%. That's the national rate. This 4 to 5% is the weighted average yield of the American bond market. That's why it's very stable, doesn't change much because life insurance companies have so many years of bonds on average produce 5% return. And they give you 4% because they have to pay the buildings, they have to pay their, keep the light on, right? This cost we have to pay from this returns. So your returns are 4 to 5% on average. This tax free, meaning this is no taxes. Yeah. All right, continue.
Number 27, what is the ultimate condition of banking on yourself?
Yeah, we mentioned that, right? You get a W-2 job, you get paid, the bank, the money go to your Bank of America, immediately the money go to New York Life or Mass Mutual, pay down your premium. And when you need the money, you borrow a loan against life insurance policies, pay your mortgage. So you have a one cycle, okay? The money does not go to the bank, go to credit card company, no. The money go to the bank, then go to life insurance companies. Then you take a loan, then you pay credit card. Okay, that's ultimate.
Number 28, why we need to do diversification with top 4 life insurance companies?
Yeah, people ask me, Mike, can you just buy a $5 million policy against New York Life? That's it. I said, no. Even the best policies, I still diversify. I have 1 million in New York, 1 million in Northwest, 1 million in Guardian, 1 million, because you never know. Sometimes life happens. I want to split. Yeah. Do not put all things into one basket, right?
Number 29, can Family Foundation own cash value life insurance policies?
Yeah, that's a very advanced question. What do you guys think? We talk about it. Life insurance is what? The money gotta be what? Gotta be post-tax money, right? You cannot deduct tax because it's. But what if you donate money into family foundation? You get 30% tax-free because you use your own charity, and you use your family foundation money to buy life insurance policies. How about that? It happens. It works. Look at my life insurance policy in your life. Okay, this is, look at Chris. I bought a Chris policy. Look at the detail. The owner is my Smart Life Family Foundation. My foundation used the donated money to pay premium and guaranteed $500,000 death benefits. So in the eyes of IRS, this is legal. Why? The payer is Family Foundation. The beneficiary is Family Foundation. The insured person is a board member, Chris Nie. He's the chief financial officer, whatever officer in the board. And this is totally legit. So all the money into this are within the Apollo Foundation, does not go out. IRS is okay with that. For me, it's the best. Why? Because I already deducted this premium from my W-2, from my 1040, because this is a nonprofit. I donated to my foundation, I have deductions. So I used deducted money to buy policies, it works. But it's the most advanced technique, right? Don't do it yourself, you have to talk to me, okay? Why this matters? Same thing. If you go back to, everything's connected, guys. We mentioned Family Foundation need to donate what? Donate 5% of money into charity, right? This is required, minimum distribution rule. What if in 2008, my foundation is required to donate 5%, but my Warren Buffett stock, the S&P down 30%. I'm screwed. I cannot donate. I don't want to sell stocks to give to Red Cross, to give to Salvation Army, because my market is down. What do? You borrow a loan from your life insurance policies owned by Family Foundation. How much you borrow? Just that 5%. You just pay your annual distribution contribution rule, just write a check to church by that amount and leave the stocks untouched. How to pay back the loan? Next year you donate some money, more money, and then pay off the loan. Okay. Or when the stock market recovered in 2010 and you sell some stocks, pay off the loan because it's a tax-free account. So you use different assets in the family foundation, you arbitrage against each other in the most efficient way.
So Mike, the Family Foundation is the policy owner, not the revocable trust?
So your question is family foundation compared with the regular, which is better? That's your question?
I thought the trust was the owner of the policy based on that Mark Kohler diagram.
For me, no, I have so many policies. Some are owned by trust, some are owned by family foundation. Yeah. I just play around different combinations here. For this one,
Okay, understood. That's fine.
do you see New York Life is the loan rate is 5.33. How come it's cheaper than Garner? I don't know why the other one's 5.72. Just unthinkable. I don't know why its policy is different, but it's roughly 5%. It doesn't matter. Yeah. Okay, so today we cover so many interesting things. Some is revolutionary. Never thought of that, right? Life insurance can be so flexible. You can borrow a loan, and you can buy mortgages, buy rentals, and the loan rate is the deduction because it's the interest, and you just do a whole cycle. And you can borrow a loan to pay tuitions because this personal loan. That's why you can order 4 policies, diversify yourself, against the cheap young people's life is better because their cost of insurance is cheaper. And do an annual review against your old policies. See, are they good, bad, or ugly? And talk with Steve Perzisi or talk with James Barber, because mention my name because I use them. All my policies go through the 2 guys. Right? They know me like from A to Z. And every year I go to these guys do my reviews. Every year I sit down with them a couple hours, go through this every policy by policy. What should I do this? Any changes? And this is a good experience. I don't know, Ted or Ariana, you are my clients, right? This is my style. I'm not doing your taxes, but my style is I go through the whole year with you, right? Month by month. That's how we build this relationship. Same thing with a life insurance agent. They should build a lifetime relationship with you. Every year they sit down with you. If your agent only meet you, sign a contract, get a commission, and run away, that's bad commission. That's bad agent because the person should hold them accountable for the policy, always follow up. That's the right professional, right? So when you meet accountant only once a year, that's a bad accountant. The accountant should meet you at least once a month, at least. Yeah. All right, I think we're done for today. One announcement is next Tuesday, I'm going to deep dive Warren Buffett's annual report. Everybody know Warren Buffett just published his Berkshire Hathaway stock, and I'm using my Zoom ID to do this. Make sure you guys join in 9 p.m. next Tuesday. And 10 things, retirement tips learned from reading Warren Buffett's annual report. Okay, I think that's I'm going to teach English. Use my Zoom ID. So we'll talk about the first prong, which is the BRAKB. I hope by doing this, we talk about 401k, life insurance, rentals. You should be good. You should fire financial advisor. They don't belong to your world. They charge you fee. They deliver mediocre returns. They don't deserve it. Okay, and you use my suggestions, please. All right, I think we're done. I see you. Hopefully you enjoyed this. Any question, let me know. I really appreciate your support. I hope one day we'll meet somewhere. Thank you, guys. God bless.